This video is for anyone who's interested in buying or selling luxury real estate in Boulder and wants to know more about appreciation and price behavior over the past decade and what you can expect moving forward. In this video, we will look at the appreciation over the past 10 years of the Boulder luxury real estate market and how it compares to the standard market. We will discuss the future of the luxury market, what challenges it may face, and what fundamental factors drive and affect its value. And we will do all of this for both single-family homes and condominiums and townhomes. I hope you're having a good day so far, and I hope it is about to get a little bit better. My name is Christopher Madaras with Liv Sotheby's International Realty right here in Boulder, Colorado. Liv Sotheby's is the primary broker for all property here in Boulder, both luxury and standard. If you would like to work with the absolute best for your relocation to this beautiful city, as many of our clients have, give me a call, shoot me an email. Let's begin. The luxury market for Boulder single-family homes starts at $3 million and goes all the way up to well over $10 million. I know starting at $3 million might surprise some people, but you have to remember the median sale price of a single-family home in Boulder is already $1.4 million. We are starting high to begin with. And then for attached dwelling, it's 1.5 all the way up to $4 million. At these price points, you will get a home both with luxury interiors and located just about anywhere in the city, including the more exclusive neighborhoods such as Wonderland Lake, Pine Brook Hills, Bellevue Heights, Panorama Heights, and Mapleton Hill. Starting off with price per square foot, this will give us the best image of how property has appreciated over time, given we are already filtering our criteria by sale price. The standard single-family market, that is homes under $3 million, we can see the price per square foot has gone up fairly steadily from the beginning of 2014 all the way up to 2024. Now, this data is on a 6-month rolling period, just so you know. That is in order to give us a little more readable of a chart. Fundamentally, here we are not looking at specific numbers as much as we are trying to get an idea of the overall trend. This is pretty standard. It's about what you'd expect. It's about what you'd see for most of the national market, the steady move from 2014 all the way to 2024. Of course, you can see we had quite a bit of volatility here from 2020 all the way up to 2023. That encompasses the period of market volatility caused by COVID-19, as well as the ensuing interest rate drop and rise. Over the past 10 years, this represents a total increase of 106% for the average price per square foot. Moving on to the luxury single family market, we can see we have a similar trend here. Of course, the chart is a little more volatile. Part of that's just because we have less data. Again, the luxury market is going to compose under 25% of the total volume. But aside from our initial drop in 2014, where we saw a lot of volatility, the market has experienced a somewhat similar steady rise as far as luxury markets go, which can be far more volatile, and we'll actually see in a moment. And this represents a total rise over the past decade of 49%, which is substantially lower than the standard market, though much of that has to do with that initial decline the luxury market experienced in 2014. Now, you might say, well, that's an anomaly, and in some sense it is, but I don't know that I would consider it irrelevant data, as in an outlier, because the luxury market is in a very real sense anomalous, and anomalous shocks like this are not so much outliers for luxury market as much as they are a feature. But aside from that, it represents a consistent 7% a year appreciation over the past decade. So the luxury market is appreciating at a pretty consistent rate compared to the standard market. We continue to see both standard buyers and luxury buyers feeling like Boulder is a desirable place and increasingly desirable in their eyes, such that they are willing to pay higher and higher premiums as the years go on. You'll also note that we did have some volatility from 2019 to 2020, which corresponds a little bit with the COVID pandemic, though you'll note that there isn't really much volatility here in the same period compared to the standard market. And this is really alluding to something we'll talk more about as we go on with this video, which is that the luxury market is fundamentally operating on really different terms, and it's dictated by different terms than the standard market. So there is a sense in which these two markets are decoupled, even though they are assets that are, in a very literal sense, neighboring each other. Moving on to attached dwellings now. This is condominiums and townhomes, starting with the standard market, so condominiums and townhomes under 1.5 million. We can see a pretty consistent rise upward, volatility around that COVID period, 2020, 2021. Now, this is similar to the single family market. This represents a total change of 103% over the past decade, about 7% a year. The attached dwelling market we typically see as being strong, and a big part of that is because the cheapest real estate is going to be condominiums and townhomes, and there will always be market, there will always be a demand for that cheaper end property because there's always going to be more people trying to get into the most affordable property on the market. However, when we change to the luxury market, now we have a very different picture, right? For the past decade, of course, there's been a lot of volatility. However, what we can see is that really the price is kind of leveling off around that $900 to $1,000 a square foot over the past entire decade. And this is really significant, right? This shows that luxury attached dwelling property is not moving up. It's not really appreciating. And so you can think about the full range of property as a band, right? So you have this band here and it starts quite wide. And for the single family market, for example, where both luxury real estate and standard real estate is appreciating, that band moves up very healthily over time. But here we're starting to get a clue that the attached dwelling market isn't doing that, but rather that lower limit here is going up where the upper limit, the ceiling, the luxury real estate is staying flat. So we're actually having this contraction in this range, this tightening of price. And keep in mind the scales of these charts for this specific type of display. They're not exactly proportional, though they are close enough to visually illustrate the point that if the luxury attached dwelling market continues to appreciate at just 2 to 3% a year, the standard market will eventually catch up, which raises some questions, but we're going to put a pin in that because that's just one clue. What I want to look at next is even better to talk about that, which is the average sale price. So we're going to start again with the standard single family market. And now this chart is really interesting. Again, we're not looking specifically at the numbers here because we're already filtering our criteria by sale price. What this is meant to do is fully separate the lower limit, the sort of floor, the bottom of property prices from the ceiling, the upper end. Because if the average price alone is just going up, that could be because luxury property is going up, but standard property isn't. It could be because standard property is appreciating, but luxury property isn't. So we want to separate these two out to really get an idea of the trend of the top and the bottom of the market. And so looking here at single family homes in Boulder under 3 million, we can see, again, very strong appreciation upwards, which means all of those properties 3 million and under are lifting up. And so that lower boundary is indeed going up. This sort of confirms that, right? And when we look at the luxury market, we can see a bit more volatile here, but we still have some consistent trend moving upward, which tells us that the lower end of property is going up and the upper end is. So we have a very healthy and robust upward moving single family market. And we'll talk more about future expectations at the end of the video, but this kind of should telegraph that across the board, buyers are finding Boulder increasingly desirable and are willing to continue paying higher and higher prices for it. If we move to the attached dwelling, however, we can see that the standard market under 1.5 million is going up very consistently and very strong, which again is because many people are coming into Boulder and they're trying to get the cheapest property, often first-time home buyers who are trying to get into whatever they can. They just don't want to rent anymore. But then when we look at property 1.5 million and above, we can see once again there's not much movement. The price doesn't seem to really want to move above that $2.5 million mark. And so this is really confirming that theory that the lower end of the market is moving up, but the upper end is staying flat. Now, there are a few reasons for this, okay? The first is that Boulder is not the sort of attached dwelling hub that many other cities like Denver, Chicago, or LA are. Part of that is because we don't have any high rises in Denver, which is one of the most valuable forms of luxury attached dwelling real estate. In 1972, Boulder enacted ordinance to limit the height of any new developments in order to preserve the beautiful mountain view for everyone who lives here. And that goes back even to 1959, where the city enacted ordinance to restrict city water surface to any development over 5,750 feet in order, again, to restrict and limit height development. So the sort of high-rise condominiums that you find in the Four Seasons in Denver, for example, which is the sort of property that appreciates over time, we just don't have that in Boulder, Colorado. The most luxurious you get in terms of attached dwelling living here are luxury townhomes, either by Pearl Street or by Wonderland Lake. And they are really nice properties, but they will never stack up to a 40th floor unit in the Four Seasons with a massive mountain range view. The other reason we see this happen is because Boulder has a very resort-esque quality to the town. And so a lot of people who buy luxury attached dwelling here, as opposed to single family, are often buying them as second homes or vacation homes. And that means two things. Number one is that they're comparing Boulder not to the surrounding towns, right? Boulder will always be preferable to the surrounding towns, and that's why the standard attached dwelling market will always appreciate very strongly here. But these buyers getting vacation homes are usually comparing Boulder not to the surrounding towns, but to other cities in the United States, maybe Denver, maybe places in California or Florida, even other places in the world they may be considering. And so Boulder isn't necessarily going to have obvious qualities that make it preferable to those other places in the way it does compared to, say, Superior or Longmont. And the second part is, if you're buying a luxury townhome for $2-3 million, at that point, you might just want to get a single family home, right? You can get a real nice single family home in Boulder for $3 million. So I think that a lot of people, when they get up to that point, they're either vacation buyers or they're primary occupants who, beyond that $2.5 million mark, just say, well, I'm just going to get a house instead. And this is a great way to kind of transition the conversation into this idea that the luxury market is really decoupled from the standard market. And there's a chart here, really interesting chart, I want to show you guys to illustrate this. So let's look at the last notable market event we had both nationally and locally. That'll be the COVID-related decline that occurred between May of 2022 to January of 2023. And you can see, similar to the national market, the single-family home market for standard property dropped by 10%, and then standard attached dwelling down by 6%. But the luxury single-family home market was up by 6%, and the luxury attached dwelling up by 2%. And this to me is such a fascinating illustration of how these markets diverge. The standard market is relatively predictable, and we will talk about that when we address seasonality in the next section. But the idea is there are a lot of forces, both economic and non-economic, that affect the buying decisions of a standard buyer. And all of those forces typically have some level of predictability in a broad sense. But many of those are dictated by financing. The luxury market, first of all, is a far higher proportion of cash deals, so no concern about interest rates there. And then the second part is that when you are better financed, you generally can get around things that standard buyers might not be able to. You're moving in the winter, kind of stinks. Well, you can just hire out all the moving, so it's not as much of an issue as if you have to do a lot of it yourself. And so this is a really interesting graph because, you know, the fact that the luxury market rose is not necessarily anything to do with COVID. It may be related. It may have also just been what happened to be the case that year, COVID or not. But the idea is this market is very, very different from the standard market and much more volatile in its movements. And speaking of volatility, I've got some more charts for you guys. Okay, more charts, okay? Surprise. Not the birthday present you were hoping for today, but it's what I got. We're gonna look at by year. So we're gonna look at appreciation. Again, this is price per square foot by year. And so we can see on the standard single family market, relatively consistent, right? Again, we have some volatility around that COVID period, but it's mostly a consistent 6 to 8, 6 to 9%. Attached dwelling, similar story. It's a little more volatile as the attached dwelling market tends to be, but again, it's consistently positive year after year. When we look at the luxury single family market, however, it is wildly volatile from 2014 to 2017, but even beyond after that period, it is a little more stable than the attached dwelling market, though it does still exhibit some volatility. And then the luxury attached dwelling market, totally volatile, right? 24%, then down by 10.6, negative 11.3, 23.6. I mean, all over the place. And so this really shows you that that luxury attached dwelling market is kind of just doing its own thing, completely irrelevant to normal market forces, and seems to have reached some level of equilibrium, at least for the time being, where it goes up, it goes down, it goes up, it goes down, but there doesn't seem to be any particular clear trend of upwards or downwards. And now to best illustrate that volatility, that decoupling of these two markets, we're going to look at seasonality. Now, seasonality is the tendency of market behavior to fluctuate based on the seasons of the calendar year. This is a very clear and statistically proven phenomenon. It doesn't just happen in real estate, it happens in stocks and bonds and crude oil and livestock. It happens in every kind of tradable asset. Real estate, for example, certainly in Colorado, has a strong tendency to appreciate in the spring. So we see in Boulder County, and Denver, almost 100% of annual appreciation occurs in just the first 6 months of the year, and almost half of that in just February and March. And so we see that, and then in the latter half of the year, we typically see statistically a decline overall in real estate prices. I will at some point do a video deep dive into seasonality, but this happens because of all kinds of reasons. The weather warming up, holiday season spending, tax season, kids getting out of school in the summer, kids going back into school in the fall, certain cycles in employment, interest rates tend to drop in the spring, which drives prices up. Equities tend to fall in the autumn, which hampers buyers' ability to purchase, as well as making them a bit more conservative even when they can still purchase. Looking at the standard single-family residential market, again, this is 6-month rolling period data, so it's pushed forward a bit, so you can still see that overall clearly delineated trend where the first half of the year shows strength and the second half of the year shows weakness. And it is the same story in the standard attached dwelling market. When we look at the luxury single family residential market, we can kind of still suss out that theme, but you can see there's a little more volatility, there's a little more independence in how buyers are operating in that market. And then looking at the luxury attached dwelling market, it is just totally random, is totally decoupled, totally independent from these broader seasonal market forces. And once again, this is because even in the luxury single family residential market, there are still a lot of people buying homes with mortgages, and that's because it's their primary occupancy. But the luxury attached dwelling market is a far greater proportion than even the luxury single family market of cash purchases. And because they are often second homes or vacation homes, the idea of moving in is not as much a factor as it may be for single family homes, where then once again, the calendar year, especially kids going or leaving school, can have a significant impact on that market flow. So that covers really the past decade of price behavior between the standard market and the luxury market. Let's talk a little bit about what you guys can expect moving forward, about what I expect to happen moving forward in both a quantitative context, which we just discussed, as well as a more qualitative thematic context. The first important conclusion is that the price band for the attached dwelling market is contracting. Again, we saw how the standard market for attached dwelling is rising, but the luxury market is staying flat. It's hard to tell what that'll mean for the future. At some point, one would expect either the standard market to level off or the luxury market to move up, because as it becomes a smaller and smaller gap for people to jump from a standard quality of living to a luxury quality of living, more people are going to start making that jump, and therefore that will push the luxury market up. I think that's going to follow the single family market, because once again, part of the reason why that luxury attached dwelling market isn't moving up is because at that price, a lot of people are just jumping ship into single family. So I think as single family increases more and more in price, we're going to see that luxury market for attached dwelling start to move up too. But fundamentally, I don't think you should expect a lot of appreciation from the luxury or even the standard single family market. And I think a good way to look at it is that the lower you are in your standard attached dwelling market price, the more appreciation you'll get over time, because again, the more people are pushing up that lower band trying to get into the most affordable real estate. That'll be closer to probably your 6-7% a year. Then as you go up in price, once you start to buy an $800,000, $900,000, $1.5 million, $2 million condominium or townhome, that's when you might see almost no appreciation over the next decade, maybe just a few percent a year annualized over the 10-year period. And that's okay, right? There's fundamentally nothing wrong with buying a property and it not appreciating. It's just important that you understand that that's something that very well may happen with that kind of product. As far as the single family residential market, I think both the standard and the luxury market, the entire market, has a very healthy and robust level of appreciation. We can see both of those levels rising together and moving upwards the entire market. So I think we'll continue seeing something like 6 to 8% a year annualized over a rolling 10-year period for the next decade. Because really, fundamentally, when we look at Boulder, the reasons Boulder is such a desirable place to live, the schools, the mountain views, the mountain trails, the climate, the proximity to Denver, the proximity to resort towns, none of these are things that are going to be going away anytime soon, certainly not in the next 50, 100 years. So anything can happen, of course, but I don't think there's anything particularly obvious that would compromise the rate of appreciation you see here over the next 10, 20, 30 years. Now that said, I don't think we're going to see as strong appreciation as we've seen over the past 40. The story of Boulder is sort of one of discovery, right? This town used to kind of be nothing. It used to just be like a hippie town, just a quaint, quiet little mountain town in the mid to late 1900s, which is very wonderful in a lot of ways. And, now it's a very different town, and it's still wonderful, but in many different ways. It was really in the past 20 years that we started seeing Boulder pop up on all the online lists of top 10 best places to live in the country. And that's when we really started seeing a lot of people move here. And so that's part of why Boulder, Colorado has seen such outsized property appreciation returns over the past several decades. While I still think that's happening, and it'll continue to happen in a certain way, I don't think we're going to see that kind of discovery-related outsized return profile. I think we're going to revert back to something closer to the national average. It'll probably always be above the national average because Boulder is, once again, an above average place to live in terms of desirability. But for example, the average price of a single family home, 2,000 to 4,000 square feet in Boulder, more than doubled in the past 10 years. And I don't think we're really going to see that sort of thing happen again in the future. But, I work with a lot of investors. I work with a lot of kind of risk and financial savvy people. I myself tend to be a pretty risk averse person, so my estimates are always a little on the conservative side. But I think that's a fair assessment, honestly, of what we've seen in the market, both qualitatively and quantitatively. This video isn't really here to provide any specific recommendation as much as it is to help you be more informed about the property market in this beautiful city. However, guys and gals, if you are interested in getting a recommendation, and if you are planning on moving to Boulder, the surrounding county, Denver, or even resort towns like Aspen, Vail, or Breckenridge, and need an absolutely exceptional broker, or even just have a few questions, give me a call, shoot me a text, send me an email. I am here for you, and I am so happy to help. My name is Christopher Madaras with Live Sotheby's International Realty in Boulder, Colorado. Thank you, and take care.